If you're an active service member or a veteran and you have been denied for your VA home loan, please stay tuned, watch this video, and find out if you were wrongfully denied for your VA home loan.
Have the strangest feeling to know what to believe in. Mm.
Now, one of the things that we want to talk about and cover is that VA is one of those loan programs that you actually have full access online to their underwriting pamphlets. Right here, they have the lender's handbook, and we're going to show you here in just a second. As you can see, this is the PDF from the VA handbook, which is available online. This is the last one that was revised February 22nd, 2019. We're just going to go ahead and skip you through. We're going to try to make this as quick as possible, but we also want to make sure that we have all the good informations that you need. This is going to be obviously from the VA to the underwriters, but it is accessible to you. So a lot of this verbiage is going to be towards the lender's underwriter. And we're going to see how much flexibility the VA home loan actually offers and how much is left to underwriter discretion, which is why it matters that you work with a lender that has zero to very limited overlays, because majority of the denials on a VA home loan is actually caused by a lender overlay. The problem is that when you're dealing with this loan officers at these lenders, they're never really openly transparent with you that you're being denied because they can't do the loan. They'll never really tell you that they can't do it, but there's plethora of lenders out there that could do the loan for you. Hopefully, by the time we're done with this video, you're going to have a clear picture of what you can and what you can't do. And hopefully, it will also help clarify you if you're within the scope after this review or if you're outside of the scope and what exactly is holding you back in a more clear explanation. Ask is there's a lot of customers, veterans that get denied when it comes to the income factor. Either it was calculated incorrectly, there was certain income that they did not want to use, or there was specific work history requirements that were asked, and the denial was for that reason, and that is strictly an overlay. It's important because we're going to see some other guidelines where that verbiage right there, right here, comes to play, which is them expecting that it's going to continue. This right here is going to be with they require the 2 year work history. A lot of lender overlays want you to have 2 years at the current job. It's not at the current job. They just want that you have a complete 2 year work history. So you could have been 7 months at this job, but as long as you had at least the other, year and 5 months of the previous job, then they're looking for 24 months of continuous employment. If there is a gap of employment, that is okay, as long as past the gap, there's still employment months, history months that they can add together to come to the 24. Go ahead and skip to the income from the non-military employment. Obviously, we have a lot of veterans or we have retired service members. Verify a minimum of 2 years of employment, generally in the borrower's current position. Again, this is not saying that you got to be 2 years at the current job or the current position. This just obviously shows some stability. So what they're looking for is minimum of 2 years employment history, preferably in the current position. 2 years of employment is a positive indicator of continued employment. If the borrower has been employed by the present employer less than 2 years, verify the prior employment plus present employment so that it can cover a total of 2 years. So, as I said earlier, they're looking to put the 24 months together, not calendar years, not 21 and 22. They're looking for the actual months so they can equal to 24. Provide an explanation of why 2 years of employment could not be verified. Compare any different types of employment verifications obtained. So we have the pay stubs, the W-2s, tax returns, and also the VOE, which is a verification of employment. It's a form that we send out to the employer, usually to the HR department, and they fill it out stating that you worked there from what's the start date to end date, pay, races, pay stubs covering the most recent 30-day pay period with the year-to-date information. The reason why it details like this is because a lot of times we want the most recent 30 days of pay stubs. That gives us a complete month picture. So that way, if you're weekly, bi-weekly, or if you're by monthly, we can see the layout of the pay stubs should have, if you're W-2, it should have your salary or hourly rate at the hours. It should also have what you've earned year to date, whether it's been under base pay, vacation, overtime bonus. It should detail all the incomes you receive year to date. The verification of employment and pay stub must be no more than 120 days old. We're looking at the 4 month. Every lender will have an inset overlay to try to make sure that their document is within 30 days, only to protect you. Some lenders actually will write with the same pay stub till the end. It really makes no difference if nothing has shifted. Sometimes it can actually benefit you by having the newer pay stub because your year to date keeps growing on what you've accrued, maybe in under bonus, maybe under overtime. All right, borrowers employed for less than 12 months. Generally, employment less than 12 months is not considered stable and reliable. However, the lender may consider the employment stable and reliable if the facts and documentation warrant such a conclusion. This is what we're talking about, the 2 year work history. It's basically saying that employment less than 12 months is not considered stable unless the lender can consider it stable if there's other facts. So here's where it asks, determine whether the borrower's past employment, training, and or education equipped him or her with particular skills that relate directly to the duties of the current position. This comes with the student loan. For instance, if you've been working for 12 months, you don't have the full 2 year work history, but prior to your job, you were actually at college or a tech vocational college course, they can actually use your school transcripts and use the time that you were in school. Not high school. High school does not count because high school is considered a given. Anything past high school, vocational, technical, college, they'll take the months by via the school transcripts, and they'll use that and they'll put those months and they'll add those months to your work history, and they can use that to satisfy your employment history because you were basically training or preparing for the skill that is directly related to the current position duties. If the probability of continued employment is high based on these factors, the lender may consider including the income in the total effective income. Also, for those of you that are getting out of the military and you already have your valid job offer, employment offer letter, you do not have to necessarily be at the current job just yet. The borrower may have a valid offer of employment, which will begin at or after the anticipated date of the closing, which can be verified. So that all the data pertinent to underwriting procedures should be considered. However, a pay stub may not be available, and this is it's understandable, right? Because you haven't even begun to work there yet. A lot of times, you're being either PCSing out or you're getting out and you want to buy a home, and you're trying to find your home and get pre-qualified before you actually go through that process, right? Because you want to guarantee your pre-qualification in your home. So what they'll do is that they'll take your actual job offer letter, and as long as it stipulates your guaranteed pay, guaranteed hours, starting date, and the job offer letter is legit, where the lender can count on when you're going to start, how much you're going to make with a guaranteed number. Usually it gets complicated if there's bonuses and commissions, because at this point, then this changes the income type. Now, if it's going to be an hourly, so much an hour, so many hours, or so much annual salary, the lender can use that knowing that there's a predetermined starting date. And you could even close before you even start the new job and have not even received a pay stub yet. Okay, so now what if you have been at your job for only a month or less? And we're going to go ahead and combine that with the fact that every job you've had prior, they have been 2, 3 months at a time. This is going to create what is a recent history of frequent changes of employment. So this is going to obviously give a little problem for the underwriter, because again, there's a lot of discretion here, and they have to basically, it says right here, it's required special consideration to determine the stability of income. One of the things that I've noticed is that we've had retired veterans that they moved into the area and obviously went for a civilian job, and then they, because they wanted to go ahead and get a job and make money immediately, but while they were doing that, they were looking for a better job and a better opportunity, and all of those moves were actually a career advancement in a related field. The person just wanted to grab the first thing available, so it wouldn't just be dragging, waiting for something. And that is actually a favorable consideration because it was for the purpose of career advancements in the same or related field. Favorable consideration may not be possible for changes with no apparent betterment. For instance, if the person was 2 weeks at a smoke shop, and then it was about a month and a half at a Family Dollar, and then it went for about another month at Walmart, and then we came back to now a Dollar General, and then the gas station. These things actually doesn't show that there's any betterment. There's nothing that was progressing about those moves. If anything, we worries the underwriter that there's actually a lack of stability as far as where is this person going to continue working. And obviously, those pays can vary, whether it can be in a similar range. Now, speaking about income, and we were talking about income from overtime, we were talking about bonuses, commission, etc. We also have the section that it clearly spells out the income from the overtime, part-time job, second job, and bonuses. It gives us the verbiage right here. Generally, such income cannot be considered stable and reliable unless it has continued and is verified for 2 years. So they always want to see the 2 years because they want to do the average, because these types of incomes are not guaranteed. They're not a given. So the income must be consistent. There must be a reasonable likelihood that it will continue in the foreseeable future based on its compatibility with the hours of duties and other work conditions of the borrower's primary job and how long the borrower has been employed under such an arrangement. One of the things that we see the most is usually with the part time. Sometimes a person is ready to buy a house and they're trying to get their finances in order so they can qualify for a mortgage, and they go ahead and pick up a second part time job. However, even though the numbers look good when it comes to the underwriting, you must have a 2 year history of having two jobs at the same time, only because their fear is that they're going to make a decision that could potentially be a financial hardship for you if later you decide that juggling two jobs in life is too much to handle. And when you lose one of the jobs or leave one of those jobs, that it could be a financial burden on you. So they want to make sure that if they're going to make the decision of using those incomes, that is something that has been there for 2 years, that you have maintained two jobs for 2 years. Bonuses, commissions, and overtimes are always going to want to do a 2 year average because their fear is that they don't want to make a decision that again could expose you to financial hardship by qualifying you based on a higher income. And as we had seen back in the 2007 and 8, when everybody was having overtime bonuses and etc., when the crash happened, the hours started getting cut, the overtimes went out the window, the bonuses and commissions went out, and there was a lot of financial hardships because everybody was planning their lifestyle around that money. But that money is not contractually guaranteed to you by your employment, by your employer. Is an added, you could say, benefit or bonus, right? So that is one of the things about a 2 year work history, the 2 years part-time income, 2 years having two jobs at the same time. Now you don't have to have 2 years with those same two employers. They just want to make sure that you have a 2 year uninterrupted history of you having two jobs at the same time. So if you traded your part-time job with Trader Joe to Publix, as long as you have that trade-off, but you still maintain your main full-time job, that is okay. Income from commissions. Verify commission income by obtaining the verification of employment or other written verifications, which provides the following, which is the actual amount of commissions paid year to date. The basis for payment is salary plus commission, straight commission, draws against commission or other. When commission are paid by weekly, monthly, quarterly, semi-annually, annually, or other. Individual income tax returns signed and dated. Now, this is some of the things that they can require only because they're trying to do the 2 year average. Again, they're trying to create a baseline here, which is where the 2 year average comes from. Analyze income derived from commissions. Generally, income from commissions is considered stable when the borrower has obtained such income for at least 2 years. Employment for less than 2 years cannot usually be considered stable unless the borrower has had previous related employment and or specialized training. Now, employment of less than 1 year can rarely qualify. However, in-depth development is required for a conclusion of stable income on less than 1 year cases. Now, again, underwriting discretion. This is when a no overlay lender can come in clutch for you because there's so much left to discretion. And a good loan officer that has experience with a no overlay lender knows how to set the case, or you could say the argument, to try to get that through underwriting. We have lenders that allow us to do to be determined underwriting, which means we can get your file looked at by an underwriter before we even go under contract with the house. So you have a no risk process to get an answer straight from an underwriter as far as what can and cannot be done. All right, we talked about non-military income. So let's talk about active military income. Active military borrowers' income for active duty military borrower, the LES, which is the military version of a pay stub, is required instead of the verification of employment. The LES must be an original, electronic, or copy certified by the lender to be a true copy of the original. Normally, we just ask you to send us a copy of your LES, and that is fine. We always like to get the month end LES and not the mid month, as the end of the month one has more of the broken down information as far as base pay, BAS, BAH, any of the additional specialty pays. We can see the allotments, deductions, etc. Because the mid month only really shows us, the monthly with the subtraction for the monthly, and it leaves a lot to that the lender can't see, and for us to determine that there's not any issues there as far as the allotments or additional incomes. All right. So now for if you're active, identifying the service members who are within 12 months of release from active duty or the end of the contract term. So you know that your LES clearly states the ETS, right? Which is going to give us the date of when you're leaving. So we're going to look at that. And if that date happens to be within 12 months of us closing on the loan, we're going to then require at that point to get your CO to give us a signed letter from his desk. Has a letterhead where it basically explains that you're going to reenlist and extend, and there's no reason why you should not be able to extend. They're going to ask you to provide a letter saying that you intend to enlist, or they want you to send proof that you reenlisted or extended your contract, so that way you're 12 months from closing still in it. If it's within the 12 months and you're not reenlisting, then VA will not be able to do the loan. They'll base it on then what is your job, what do you have lined up to make a financial decision. They wouldn't be able to use the income from your being active if you're going to be exiting or retiring within 12 months. And that's what this section here shows us. So for acceptable, if the date is within 12 months of the projected date that the loan will close, the loan package must include one of the following items, and this is per VA: documentation the service member has already reenlisted or extended his/her period of active duty to a date beyond the 12 months. Uh, Statement from the service member that he/she intends to reenlist or extend his/her period of active duty to a service date to a date beyond the 12-month period, plus a statement from the service member's commanding officer, the CO, confirming that the service member is eligible to reenlist or extend his/her active duty service as indicated, and the commanding officer has no reason to believe that such reenlistment or extension of active duty service will not be granted. All right. So the analysis of military quarters allowance, basic allowance for housing. So this is where we're going to talk about the BAH. Include the military quarters allowance in effective income if properly verified. Now we're going to see that in your LES. Obviously, we need to make sure that because those things are geographical, right? Where you're going to be, what's the location? It's going to be based on rank, rank, time served, and where you're at. So we're going to always make sure, especially for PCSing borrower veterans, where they may be receiving a higher BAH where they're at, and it may be reducing where they're coming, or it may be going up. So they want us to make sure that we verify that, because that is a non-taxable income that actually can be grossed up by 25%. So we take your BAH, multiply it by 125%, and that'll give us the income that we're actually allowed to use, because your base income is taxable, but your BAS and BAH is not. The verification and analysis of the basic allowance for subsistence or the rations allowance, right? Any substance rations and clothing allowances are indicated on the LES, which is the BAS, is also a non-taxable income. Same thing. We're going to basically make sure that we give you credit for your base pay at value. We're going to take your BAS and your BAH, and we're going to go ahead and gross it up as a non-taxable income. They are going to make us want to make sure that we carefully looked into the area, only because it does change based on the region, and the verification and analysis of other military allowances. Now, this is normally where you see the parachute, scuba, flight, hazard pay. So we're allowed to use this. It basically gives us the guidance here to consider military allowance in the underwriting analysis, obtain verification of the type and amount of the military allowance, how long the borrower has received it, and the continuance into the foreseeable future. Military allowances may be included in effective income only if such income can be expected to continue because of the nature of the borrower's assigned duties. And then we goes into the such allowances include but are not limited to proficiency pay, such as linguistic, parachute, scuba, flight, or hazard pay, and overseas or combat pay, sea pay, submarine, etc. So these incomes we're able to use as long as we can show that they're going to continue. If the duration of the military allowance cannot be continued, that source of income can still be used to offset some short-term obligations of 6 to 24 months duration. We've actually ended up being in this predicament, and we were still able to not, while not using it as income per se, we were able to actually use it to offset some of the payments and the debt for the debt to income ratio purposes. Okay, this is one of the things that we talked about right at the beginning. We actually closed a VA loan for a veteran that was denied by a veteran lender. You've probably heard of it, initials VU. And they said it was because of the work history requirement. And this is what the verbiage actually reads: analysis of prospects for continued employment. Cases involving recently discharged veterans often require the underwriter to exercise a great deal of judgment and flexibility in determining whether the employment income will continue in the foreseeable future. This is because some veterans may have little or no employment experience other than their military occupation. Continuity of employment is essential for a veteran with no retirement income or insufficient retirement income to support the loan obligation. If the duties the borrower perform in the military are similar or directly related to the duties of the present position, use this as one indicator that the employment is likely to continue. Most cases fall somewhere between these extremes. Fully develop the facts of each case to make a determination. The guidelines under self employment income in topic two, blah, 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 blah. Ultimately, what this is basically telling us is that it wants the underwriter to exercise great care. It wants to make sure that they understand that sometimes when you come into the civilian life and a civilian job, you find yourself that perhaps you don't have the experience, it's not what you really wanted to do, and it creates that instability. However, when you do this, I mean, you have to, the loan officer, an experienced loan officer, will talk with you. And when the application process, a lot of these things come to light. If there's any reason to be concerned because of this, it gets brought up early on the process. However, you have to, you got to make due diligence because there's so much underwriting discretion. This is a loan that we actually ended up rescuing, and we ended up closing it because it was denied by this huge VA lender. And this is a decision that was made. It was a bad call, but it's an overlay or a misinterpretation of the actual guidelines that are given to us by VA themselves. With today's market, one of the things we want to tell you veterans is that with your VA home loan benefit, having a zero down payment is a big way not only to put a roof over your head, but also to look into making some additional money. You know that the VA actually allows you to use your benefit to buy a 1 to 4 unit property, right? We're talking about not only a single home, but even a duplex, a triplex, or a quadplex. We actually did one for one of our veterans. He actually went all out and got $1 million property, but as long as you actually live in one of the units, it still satisfies primary residence. So here's the guidelines, and it basically walks you through this. The verification of the multi-unit property securing the VA loan. The veteran borrower must occupy one unit as his her residence. That is all the requirement. For purpose of determining the VA guarantee, lenders are instructed to reference only the 1 unit limit column. So basically, you're looking at the verify the cash reserves totaling at least 6 month mortgage payments. And this is only because you're going to have a mortgage payment based on the whole building, right? And if you're planning on renting unit 2, 3, or 4, they just want to make sure that you at least have 6 months mortgage payments so that therefore you don't fall in any hardship if you're unable to secure a renter for one of those other units. Ultimately, all they're caring is you're living in it. So you satisfy primary residence, primary home, you have the reserves. So now, it gives you the ample time. And ultimately, you'll be surprised how if the more units, the more you can actually wash out where you live for free on your side of it, right? Imagine you be able to have let's just say $4,000 payment for the loan that covers the whole building. But if you're renting at $1,600, $1,800 the other 3 units, you're essentially having renters that are paying for your mortgage, which eventually after 12 months, you can use your VA benefit again and buy another house with your zero down VA and then rent that fourth unit that you are now no longer occupying. And now you have four rentals while you're still the proud owner of your new home. Missed opportunity here, and I think it's because it's misunderstood. For other types of income that are allowed to be used in the VA loan, you got pension, retirement, disability, dividends from stocks or other, interest from bonds, savings accounts, royalties, notes receivables, trust. Um, most of the things they want to know is, will the income, does the income have a chance of continuation? Well, is it likely to continue? In most cases, if they find an income that they don't feel that it has a likelihood of continuing, they'll usually try to use it to offset some of the short-term obligations, 6 to 24 months, which it's not ideal for the income, but if we can use it to offset some of the debt and the liabilities for debt to income purpose ratios, it can help us significantly. One of the things that we get asked a lot, and I think this is the one with the biggest debate, the post 911 GI Bill benefit is income. I've seen a lot of things on YouTube and TikTok where they say that you can. And this is one of the things that I see, and this is again from the VA. And it says right here on 4-31 of the VA pamphlet, do not include temporary income items such as VA educational allowances, including the post 9/11 GI Bill benefit. All right. Now, when it comes to the cash to close, VA allows 100% gift of funds. This also comes with a lot of questions that we get, so I want to go ahead and share some of that here. A gift can be provided by a donor that does not have any affiliation with the builder, developer, real estate agent, or any other interested party to the transaction. There has to be a gift letter that we will provide. The gift letter must specify the dollar amount of the gift, include the donor statement that no repayment is expected because it's a gift, not a loan, and indicate the donor's name, address, telephone number, and relationship to the borrower. The lender must verify that the sufficient funds to cover the gift have been transferred to the borrower's account or will be documented as received by the closing agent at the time of closing. So the acceptable documentation are going to be evidence of the borrower's deposit, a copy of the donor's funds by check, electronic transfer to the closing agent, or the CD showing receipt of the donor's funds. A lot of times what we ask for this is we're going to ask for the gift letter. The gift letter is going to come from Auntie May. Auntie May says, I will give my niece the money for the loan. It's going to come out of the checking account. I'm giving her $5,000. I don't expect her to pay it back. Signed, and the veteran signed. Boom. That is the gift letter. Then we need the evidence of the borrower's deposit. So if I, Auntie May, already gave my niece the money, then we need to evidence that through the bank statements of our customer, the veteran, that shows that here's the 5,000 Auntie May gave me. But then we also have to now get a copy of the Auntie May's check, or if she did a transfer, then we're gonna need Auntie May's bank statement where it shows the withdrawal of the $5,000 to our customer's account. At the end of the day, it's about follow the money, right? We have to source the money. So a lot of times we get family members that they're like, I will absolutely gift you the money. And when we ask for these things, then they're like, nah, I feel like you're asking for way too much information or getting too much into my life. I don't feel comfortable doing that. The lender doesn't request this because the lender wants to get in onto May's business. The lender's only doing this because they got to cover their six by being able to source that Auntie May had the $5,000. Auntie May, $5,000 came out of her account and it went into your account as the gift. Now, if she doesn't want to give it to you, she can most definitely send it straight to the closing attorney. And the closing attorney will then show us receipt of the funds from the gift. Then we will need the gift letter, the closing attorney showing us we got the money, but we will still need Auntie May showing us that she sent the money to the closing attorney. It's following the money. Now, one of the tricky stuff is that, on the LES, we said earlier about the allotment section. When the pay stub or LES indicates an allotment, the lender has to investigate the nature of the allotment to determine whether the allotment is related to a debt or other obligations. For instance, in a lot of cases, the allotment will have a certain breakdown section. And sometimes you will tie up some of your bills, like your car payment, your rent, even though it should come on privatized housing. But a lot of times you'll get your rent, your car payment, or a credit card, or you're trying to split your pay into 2 or 3 different bank accounts. So we now need to be able to get verification that that allotment actually ties into that account. A lot of times, the account that the allotment is going into is an account that we already seen on your credit report. But because the allotment section doesn't really break down clearly where that money's going, and the lender sees that there is money coming out of your income, but we don't know exactly where it's going, we need to get the paperwork. The good thing is that with DFAS, at least you can always go in the system and you can get your allotment section, and your allotment will say exactly everybody you signed up with and who they all are. And that will help the lender connect that that allotment is going to Bank of America. Bank of America happens to be where you got the credit card. It's going to Navy Fed, and Navy Fed happens to be your car loan. They need to connect it. Just to give you the heads up, because they're seeing that there's a deduction away from your income, but they need to make sure if that is a debt that is already being accounted for because of your credit, or if it's a debt that is not even listed on your credit. Cool little feature. Analysis of debts and obligation. They have this section. If you have a debt on your credit, we're looking at installment, because obviously installment half months revolving never really closes. If you have an installment loan with 10 months or less, and now I want to read this to you just so you can get the verbiage, and I'll explain where the discrepancy seems to sit around. Significant debts and obligations include debts and obligations with a remaining term of 10 months or more, that is long term obligation, and accounts with a term of less than 10 months that require payments so large as to cause a severe impact on the family's resources for any period of time. So, what this is telling us is if you have an installment loan debt in your credit, and you have 5, 6 payments to go to have it paid off, I've noticed the threshold to be around $150 payment. If it's around $150 payment, I can usually get the underwriter to just go ahead and omit it. They'll not even count that debt because they know that debt is going to be paid off in a jiffy. It's not a big deal. However, look at the example they use, and I've seen this to be true. Even if you only got 5 months left on a $1,500 balance, but $300 payments, because $300 is considered significant, they will have to count that to make sure that, and again, it's not to hurt you, it's just to make sure that there's no financial hardship caused because they were too aggressive in how they calculated your obligations and your payments. So that's what they're looking for. Again, even though there's no set number, I found that I've been able to push to $150. I think there was one case that it was only 2 payments left, and it was like 190, and I was able to get it omitted because of how many months it was left. But mostly the system will try to automatically take something very tiny and automatically just omit it out of there. Normally, we can ask the underwriter to go ahead and take this debt and not count it because it's an installment loan with less than 10 months and the payment is reasonable. And you'd be amazed what $150 taken away from your debt can do for you and your qualification and even purchase power. All right. Another thing that we see a lot is with our VA home buyers, that they'll have under credit a co-signed debt. Most likely, usually, it's a car, especially because they either co-sign for spouse, significant other, while they were enlisting, so they could leave the other with the car. Now, that person has been making all the payments on time on the vehicle. A lot of times, when we have certain difficulties, realtors would advise that there's a solution because it's a co-authorized, co-signed loan. The verbiage is a little more specific than that, though, and I want to go ahead and illustrate exactly where it comes from. So the borrower may have a contingent liability based on a co-signing, but the lender may exclude the loan payments from the monthly obligations factored into the net effective income calculation if in the loan analysis, if there's evidence that the loan payments are being made by someone else and the obligation is current, and there's not a reason to believe the borrower will have to participate in repayment of the loan. Now, if you have, for instance, if we have Joe, who's applying for his VA home loan benefit, and his wife Jolene is the one who's making the payments, and we ask for the evidence of that, and he gives us Joe has his own checking account and Jolene has her own checking account. And we can show that for the last 12 months, or as long as the account's been open, Jolene has been the one making the payments and Joe never once had to make a payment on that. We can get the underwriter to not count that debt with supporting evidence that Joe has never made a payment. Joe will not make a payment. Jolene has been making payments and she's making on time payments. And that's how we get that omitted. Other than that, unfortunately, VA does not give us the breathing room to take it out. If it's a joint account or if it has been delinquent, if it's been delinquent and we're trying to blame the late payments, Jolene was supposed to pay it. It's not really me. Unfortunately, when you co-sign, you also assume responsibility. And unless there's a divorce and a court order, we cannot take that away from your responsibility. The credit hit stays. The liability, the responsibility for the payment can be taken out only with a divorce court with the award that somebody else was supposed to make payments. Other than that, if you show that it's been on time and Jolene's the one making the payments, then yes, the lender can go ahead and with that supporting evidence, not count that against you. All right, and this is where it gets really interesting, and this is where we cover the meat and potatoes of the VA loan with a no or very limited overlay lender. Credit history, required documentation and analysis. VA does not have a minimum credit score requirement. Now, well, that is true because VA does not do the loans directly, they only insure them. The lenders do. All lenders have a set of overlays. Whether it's very minimal, very limited, they all have an overlay. Why? Because they have a credit score requirement. For instance, the most aggressive VA lender I have has a 500 FICO score minimum score requirement. Now, they're following the VA guidelines in just about all the other aspects. There's a reason why they do this, and we're going to go into why saying that you can go under 500 is a really big catch 22. Let's go with rent and mortgage payment history, borrower's most recent 24 months rental history, and any outstanding assume or recently retired mortgages must be verified and rated. Now, if you have a mortgage, we're going to see it on your credit report most likely, unless you had a private lender. Rent history is very big. On approved eligibles, which is an automated approval from the system, they actually go ahead and bypass that. They don't care. They're saying like you're golden. If you're manual underwritten, which means the system is saying like there's some risk factors here that I as a computer can't make a decision. I need an underwriter to manually review this and follow our checklist. One of the things that will ask mandatorily is going to be the borrower's most recent 24-month rental history. They're going to want to know where have you lived in the last continuous 24 months. And if you were staying in a place where you rented, they're going to need to do a verification of rent. They're going to send that to your previous landlord, and they're going to ask them to say how long you lived there, how much was your rent, and did you pay your rent on time? Because they're going to need that housing history. Absence of credit history. This happens when, for instance, we get a lot of veterans that they're young. They basically just left high school, joined the army, joined the military, and now they're looking at buying their first home. But they never really did anything to establish credit. I mean, literally, they just left mom's house and joined the military, and they have no credit scores. Now, VA does allow you to have no credit score. There's a difference between bad credit and no credit. Bad credit is when you go under 500 or there's a lot of dings and dents on it. No credit is someone that has no established credit history. And when we looked at their credit report, it's empty. There is alternative non-traditional credit methods that can be done with this. It is not considered an adverse factor if it's because no credit has been developed as of yet. It's been using cash, rather than credit. There has been no disruptive credit events, and everything as far as the credit looks good. Now, when they say alternative, what they're going to do is rental history. They want to get, again, this is going to cost a manual underwrite. Manual underwrite is going to cost 24 months rent history verification. If you just came from mom and dad's, then they're going to want to know, did you have at least four trade lines under your name? If you don't have rent, did you have utilities? What about electric bill, the water bill, the TV bill, the cable bill, the internet bill, the home phone bill? They're going to want a 12-month history of things that you have paid. Now, it gets a little blurry because it does sound like it's a more optimistic thing than it is, because there is a slight catch 22, right? Because if you just came from mom and dad's, you obviously didn't have anything under your name, so it does limit us. However, the lender does have a flexible guideline there, but they want you to make sure you at least at minimum meet that. And you got to understand, the lender has no way to measure any type of risk with you, because there's nothing on your credit and there's no proof that you've managed to pay anything on time. So a lot of the times, if you do PCS into an area where you're now looking into buying, but this is your first time on your own, this will be a good case that rather than pursuing this, it'll be a good time for you to go ahead and get your 12-month lease, get your 12-month rental history, go ahead and get the utilities under your name, your car insurance, etc. Create that, because even if you still opt to not build credit, you at least have generated sufficient non-traditional trade lines for you to be able to get an alternative credit loan. But you can also use things such as Experian Boost, where you can report such things that you're paying, and they would actually take that and report that on your credit to help you generate a FICO score. All right, and now going into the adverse credit data. This is how we analyze good credit and bad credit. VA actually has one of the most straight through ways of doing this. In circumstances not involving bankruptcy, satisfactory credit is generally considered to be reestablished credit after the borrowers have made satisfactory payments for 12 months. Essentially, that's what we call the reestablished credit rule. With VA, they're always going to want to analyze your payment history for the last 24 months. Anything prior to 24 months, it'll be a cause for any ding on your credit score, but they'll actually look past it. What they're really going to focus on the most is going to be, have you been on time for the last 12 months? In other words, shit happens. But have you, for the last 12 months, made on time payments to reestablish your credit? So that way, when we ask you what happened with the previous 12 months, you can tell us that whatever happened or occurred at that moment, however, whatever the hardship was, you overcame it. So they will ask you to do a letter of explanation where you explain what happened to every derogatory credit item on your credit for the last 24 months. But as long as we can show that for the last 12 continuous months, we have had a good on-time payment history, you'd be amazed on the flexibility the underwriter will give us. We've even had customers that did have a slight dent on their credit in the most recent 12 months, but we could also substantiate and support that if they look at the overall credit history, the person had only had three dents through his whole credit history, and we got the loan successfully approved and we got it to close. But this is where the recipe to how we do things, the way we do things, we are able to go down to a 500 FICO. We're able to do manual underwriting with very limited overlays. And what we're looking for is that you at least have maintained your most recent 12 months of payment history on time. Now, if we pull your credit and we see that you were just late last month on the credit card and your car payment, unfortunately at this point, then VA does not have any guidelines or even room for discretion, because their checklist as far as analyzing credit lies right here. This is where the secret sauce is to everything that makes VA so flexible. Again, the flexibility shows with the collection accounts. Isolated collection accounts don't necessarily have to be paid off as a condition for the loan approval. If the credit report, shows numerous satisfactory accounts and one or two unpaid medicals, it is what it is. They do understand that those collections though will hit your credit. It's part of your, right here it just says collection accounts must be considered part of the borrower's overall credit history. Unpaid collection accounts should be considered open recent credit. So again, when you have these collections, it's part of your ding, but they won't require you to pay them off if it's just one or two collections within your credit. Now it does have that borrowers with a history of collection accounts should have reestablished satisfactory credit in order to be considered a satisfactory credit risk. So it does take us back as we keep going down the credit analysis. It keeps bringing us right back to the adverse credit data, which is telling us again, Is all great. We get it. We forgive you, but we want to make sure you had 12 months of on time payments because that's what's going to clarify it for us that you have satisfactory credit risk because you have now reestablished credit. And that is, believe it or not, a lot more flexible than everybody else because FHA actually has a little flexibility on the credit cards as long as you don't hit the 90 days, no late on the last 12 months with installments, and you basically have 3.5 down, only down to 580. Under 580 you got a 10% down. So when you really look at how flexible they're being, they're just saying, just give me 12 months that you've reestablished yourself. All right. And another thing that we see a lot, payoff of unpaid or untimely debts. What this means is, look, if we pull your credit and we tell you that we couldn't do the loan because you had this collection and that collection, paying the loan off. And this happens a lot where we get a call from the realtor. Hey, talk to James because James just paid off that collection and the charge off and the other one. And it's like, that doesn't change anything. I mean, based on VA, and it's right here where the verbiage is for unpaid or debts that have not been paid timely, payoff of these debts after the acceptability of a borrower's credit is questioned does not alter the unsatisfactory record of payment. A period of making timely payments on subsequent obligations for at least 12 months, then satisfactory credit is considered reestablished. So what this is telling us is, again, great, you paid it, but it doesn't remove the fact that you were late, the months that you were late. It doesn't change the fact that you had the dents, you had the dings, you had the late payments. Pay it off or not, you have to wait 12 months of on time payment history to meet the reestablished credit rule for the satisfactory credit. I just wanted to be able to share that because this is the one thing that seems like a lot of realtors rush their clients to pay all these things off. Well, pay it off and call them back. See if we can get you into a house tomorrow. It doesn't work that way. If there was anything that we could have seen to help you at the moment, we would have given you the advice to get you pre-qualified as soon as possible. And what you did paying off a charge-off account was actually wasting money because the charge-off account was already being handled differently by the lender because, again, charged off accounts, these accounts are typically collections in which the creditor is no longer pursuing collection of the account. The underwriter must address the circumstances regarding the negative credit history when reviewing the overall credit of the borrower, which means that the lender is not going to make you pay it off. As a matter of fact, the lender is reading it as a creditor that already gave up on that account. So you taking $3,000 to pay off a charge-off account did nothing to your payment history. You're out of $3,000 that you didn't have to be out of. And a lot of times this we get a lot of customers that were actually able to pre-qualify. And then we come to find out that the money they would have needed to be able to buy a house today was spent because the previous lender had them spend all that money paying everything on their credit because they were playing minesweeper with the person's credit history. So I even counsel highly against those programs that these lenders have, like, that, oh, if we can help you, we'll help you fix your credit, but just keep us here. A lot of times they'll just blindly tell you to do all these random things, but they're not really doing anything. They're literally just playing minesweeper with your credit. Pay this, pay this, pay this, pay that. And then they have you triggered in some system that when you come to me, and I'm successfully able to get your credit score up and I'm getting you into a home, their trigger system lets them know that your credit is now within scope. And they'll call you magically to tell you that, hey, congratulations, we can do your loan now. Let's go. And it's, at this point, tell them, here's the kite and a ton of string. Go fly it. That's just my 2 cents. All right, so now we're going to talk about the automated underwriting cases. This is what I said previously about the approve eligible with the automated approval and the refer eligible for manual underwriting. So this is telling us that the automated underwriting, AUS stands for automated underwriting system. This is going to be the automated system that scans to the file and it tells us yay or nay. And it also tells us, refer eligible, which means, hey, get a manual underwriter to do the checklist. So let's go ahead and look at real quick what exactly we're talking about here, because the guidelines are here for you to see. Subject and reference, documentation, right? This is going to tell us anybody that comes refer eligible is this column, and anyone that is approve eligible is essentially this column. So what this is telling us is that your credit report is good for 120 days. So whenever we pull your credit, that credit report is good for 120 days, meaning that from the moment we pull that credit to the moment your loan closes, it funds, like the closing table, you sign. If we're within 120 days, that credit report is still good. If we pull that credit report and the closing date 120 days have lapsed, the lender is going to require us to pull another credit report because now the other one is stale, is too old. But again, a lot of clients always tell us like, "Oh, I'm not ready to pull my credit yet because I'm not looking into buying for 2 months." The thing is that if I pull your credit today and that's when you're trying to buy, that credit report will still be good for us. But how can I properly pre-qualify you if I'm not seeing all of the information? A lot of times you will go ahead and Google what is the credit score requirement for VA, and you're going to populate one of these other VA lenders out there that are going to say 640, 620, and you're going to go on Credit Karma and you're going to see a different score, and you may even find yourself feeling defeated. Or on the opposite, you may feel extremely optimistic, not knowing, for instance, Credit Karma has a very interesting score algorithm where for clients that have a perfect payment history but they have a high credit usage, Credit Karma will actually penalize them and give them a lower credit score than they have in real life with the mortgage FICO model. Consequently, if you actually have late payments and some dings and dents in there, Credit Karma may be a little more generous. And when we pull your application with our scoring model, you may actually score under what Credit Karma has. So you're really flying blind here. One of the concerns that I have is like, for instance, I've noticed a few customers that have attempted getting pre-qualified online with some of these heavily VA lenders, but they have this system where you just put certain information without pulling your credit or doing any due diligence. They'll spit out a pre-qual. Boom, here you go. Let's go. And a lot of times, these deals fall through after under contract, and then I get the phone call trying to rescue. When I look into it, there's just circumstances that not even with their underwriting guidelines for manual, the loan could have been done. And same as others, I've seen people that were defeated, and when they called me, I'm like, "Are you kidding me? You're like a paper." So it's really hard for you as a consumer to know exactly where you stand. So I mean, the credit report just has such a long shelf life that I really, I'm showing you here the 120 days. Just use it. Get pre-qualified with the credit report. And once you have your credit pull, you have a 30, 45-day window to go ahead and shop around with other lenders, and your the bureaus will see it as all one inquiry. I've seen a little glitch on that when you go to a bank because banks also do credit cards and other type of loans and just mortgages. Sometimes the identifying factor on the bureaus doesn't really let them know that it was for mortgage, and unfortunately, you get dinged for every inquiry. For instance, we're strictly a mortgage broker, right? So everything we do is mortgages. So our code is going to be that it was for mortgage purpose. So it's going to let them know that if you go to another mortgage lender that just do mortgages, it's going to read all those inquiries now as just like one that has been done within that window. Explanation of discrepancies in reported debt. There's no explanation required with refer eligible. And even if you're approve eligible, it's following the same documentation. Rental payment history. If you're approve eligible, like I had said on the previous one, where it says there's no verification of rent. If they feel like if it's blue, let it go through. If it's manual underwriting, then they're going to ask you to provide a 24-month rental history directly from the landlord. That's the verification of rent that I was saying. Verification of significant non-mortgage debt. Obtain direct verification for significant debts not reporting on credit. Note, significant means that the debt has a monthly payment exceeding 2% of the stable monthly income for all borrowers. Now, if it was approved eligible, the same follow the same guidelines as here. Perform manual downgrade to refer if direct verification reveals that more than 1 by 30, which means that more than one time you've been 30 days late. So if they, like for instance, when you buy a car from a buy here, pay here, that doesn't show on your credit, but the underwriter can see when they look at your bank statements and they're seeing that in those 2 months there was this payment made. Whenever they want to validate this debt that's not on your credit, they now have to get a payment history from this creditor. And if it shows that you have more than one time you've been 30 days late in the last 12 months, now that approved eligible that you got is going to be manually downgraded because you didn't get the correct classification because they just couldn't see it on your credit. The mortgage payment history, the same, basically downgraded manually if more than one 30-day late. And they're going to want to get the housing verification for mortgage or rent. Account balances, if a mortgage or other significant debt is listed on the credit report as past due, this is going to show, this is going to follow the same guidelines on that. Derogatory credit information, no determination of credit worthiness is required with approve eligible, which means the automated system said if it's blue, let it go through. We don't care about anything on the credit. If it's a manual underwrite, then we have to obtain an explanation for any derogatory credit. And this is going to be, like I said earlier, about the 24 months. You got to have a 12-month clean payment history, but then we got to explain any derogatory in your credit within the last 24 months. And that is if you're a manual underwrite. But again, being a refer eligible manual underwrite does not mean you should get denied. It just means that a lender could have potentially denied you based on an overlay. But here we showed you exactly what is an overlay and what it's not. So if you don't have the 12 months payment history, the 500 plus FICO, then obviously now we're starting to walk into the realm of VA will not do that loan. For employment gaps, if you're an approved eligible, if you have an employment gap of 60 days or less, you don't have to provide an explanation as to why you had that gap. If you're a manual underwrite, refer eligible, then you have to explain the gap that's over 30 days. So no explanation for employment gaps if the gaps are less than 30 days. But if they're over 30 days, then you have to explain that gap, because now they're more concerned with the stability because of the credit. They want to make sure at least the income part is stable. All right. And one of the final ones, benefits of approved eligible over manual, it is the verification of assets. For instance, approved eligible provide bank statement, asset statements covering the most recent 1 month. Refer eligible provide the most recent 2 months. Now, one of the things that the reason why that matters is mostly because of the deposits. For instance, let's say that, remember that when they're sourcing your money, they're looking at the most recent 2 months of bank statements, right? Any large deposits other than your base pay, your income, income derived from your job, they're going to ask what is this and where it came from, and you have to source those funds. And not any deposit, mattress money, coffee can money, money from the safe at the floor of my master room closet, most of those type of deposits into your bank account are not considered acceptable when sourcing of funds. However, if when they get the bank statement, you already show the balance, that money was already there prior to the statement that the lender is now seeing, then that money is considered seasoned, which means the lender is going to take it as this is money that you already had. This is money that's part of your savings. And the lender will not ask for a gift letter or sourcing or explanation, because as far as the lender is concerned, that money was already there to the date prior to us getting the bank statement. All right, now let's go ahead and talk about the credit history. So, right here, right off the handbook, a poor credit history alone is a basis for disapproving a loan. If credit history is marginal, look to other factors such as residual income. Compensating factors. Compensating factors may affect the loan decision because these factors are especially important when reviewing loans, which are marginal with respect to residual income or debt to income ratios. Now, they cannot be used to compensate for unsatisfactory credit. So when we're looking at this, sometimes we have a loan that is a little tough. We really have to do a really good job selling it. I think our loan officers here at Simple Lending, I think we're becoming more of attorneys than loan officers when we're trying to help our clients, but we love what we do, right? Compensating factors include but are not limited to excellent credit history, conservative use, consumer credit, minimal consumer debt, long term employment, significant liquid assets, sizable down payment, the existence of equity in refinancing loans, little or no increase in shelter expense. What this means is that if you're already renting at $2,200 and your proposed mortgage with taxes and insurance is 2150 or 2218, they're looking at as a compensating factor that, hey, you've been renting this time, paying on time, you're not really bumping up in your housing expense. That's considered one. Military benefits, satisfactory home ownership experience, high residual income, low debt to income ratio, tax credit for childcare, and tax benefits for home ownership. So what they're saying here is that you cannot use compensating factors to overcompensate for really bad credit. right? And we get that. But if we're going to make a case, hey, look, Johnny had a rough go about 2 years ago. We see that the last 12 months, Johnny's been great. But Johnny makes this much money and Johnny wants to buy this house, and his payment is a little high debt to income ratio wise, right? His debt to income ratio it's on the higher spectrum. But there's a lot of benefits that support why Johnny should be able to get this house. And this is where we come in. So obviously, Johnny wouldn't have excellent credit history, but what if Johnny's credit history was bad from whatever happened 2 years ago? But lately, we show that Johnny has two credit cards that have a zero balance on them, and everything else has been paid off for the last 12 months. The only thing that Johnny has is because he doesn't have a lot of movement on his credit hasn't really gone up from the time that he had those late payments. So that is a conservative use of consumer credit. Minimal consumer debt will also fall into that because guess what? He doesn't have much debt, and he's been at his job for 7 years, and he's got about, $17,000 in the bank, and he doesn't need any of that money right now, because he has a zero down payment and he got seller credits. So right there, we just started spitting out a few compensating factors to justify why even Johnny can get this $500,000 property, because whatever happened to him satisfies the satisfactory credit, reestablished credit rule. And look at all the compensating factors that Johnny now has. These are great tools. Also help us in a lot of cases. Like for instance, we had a veteran who his wife worked, but did not have a very good credit score from a previous divorce, and he was trying to buy this home for his family on his own with his income. His debt to income was at 73%, because VA does not really have a debt to income limitation. His file was good, and he had all those compensating factors. So those things were used for the lender to approve the loan. So these are factors that, again, they're not here to overcome negative credit. They just cannot be used to compensate for unsatisfactory. If we met satisfactory credit and we're trying to push the envelope or make a case, these compensating factors listed here are the ones that can be used at underwriting. All right, guys, and that's it. That we pretty much cover the full chapter 4 VA pamphlet for credit and income analyzing. So now you know exactly how we do the things we do. And hopefully, you also learn if you have been denied for any of the reasons that we just showed you here, that you could have been approved. Listen, I'm not selling you anything. I tell everybody I am the worst salesman in the world because I don't believe in selling something that is good for you. I just want to educate. I want to teach. I want to let you know we're here. If you have any questions with no sales pitch, leave us a comment. Let us know. We'll be glad to show you. We can even go ahead and share some notes. Maybe we can help you in your area. We're licensed in the state of Florida and the state of Georgia. If we're not in the states where you're from, but you have some questions in the broker channel, we are very well connected with the network of brokers, that we will be glad to connect you with brokers to have access to no overlay or very limited overlay lenders that could help you take full advantage of your VA home loan benefit. This has been George Rivera with Simple Lending Mortgage. Thank you.